This Week in Economics on the 15th of January 2017. Our last report before the age of DJ Trump. He will appear on the national scene on Friday. I believe it's the 20th of January at 12:01. He should become the president. He'll take the oath, and away we'll go. We'll talk a little bit about what's going on with the banks in anticipation of DJ Trump. And from Davos, Switzerland, which that particular event will start. We cover it every year shortly here. And what they anticipate will happen in the global economy as we look at a de-escalation from the emphasis on internationalism. Those are some things we'll talk about. We'll also, from the market people, we'll have the PMIs looking at the American economy and the Eurozone economy and where they are. We'll start off with Bloomberg here, has an interesting article on Davos, the World Economic Forum as it's known. Wonders if it's part of the problem is the article by Simon Kennedy and Matthew Campbell, writing on the 12th of January. This Ken Rogoff pinpointed the moment when he started to grow concerned about DJ Trump would be the next president. It's when Rogoff, fellow attendees at the World Economic Forum annual meeting last January, that it could never happen. A joke I told 1,000 people in the month since leaving Davos is the conventional wisdom is always wrong. He's a Harvard professor and he's a former chief economist of the International Monetary Fund. No matter how improbable the event, most likely to happen is the opposite of whatever the consensus at Davos. The Davos summit, the repeated failure of business and political elites, as they are now called, to predict what's coming. Last year included the UK vote to leave the EU. It doesn't strike those returning this month to the Swiss Alps and where they will be. After a year of political upsets, rocked financial markets, killed off careers of once dominant Davos going politicians, no doubt about it. In the 4 decades of its existence, been around 4 decades, the World Economic Forum has nurtured a broad consensus in favor of globalization and open markets. Its core notion is that capital goods and people should be able to move freely across borders, a principle that can deliver huge benefits to those with education and money, but seemingly terrifying to those without. For the 3,000 people who will convene, that would be on the 17th and 2 days to the 20th. It could be a moment of reckoning. Speakers at the podium, coffee bars, ubiquitous late-night parties. They'll be asking themselves whether Davos has become, at best, the world's most expensive intellectual feedback loop. At worst, part of the problem. Since the recession or depression, we call it, the boom has benefited the upper income earners and done little for those in the middle or less. The backlash, said Norman, I think that is pronounced Norman, N-A-R-I-M-A-N, Beshacic. He's the chief economist for the research project at IHS Market, which we'll be talking about that. The Davos version of the world has not delivered a broad economic recovery. That the world is entering into an era of populism that appears apart long-established, that tears apart, long-established bonds is beyond question. The result of the basics vote threatens the EU's most important trading relationship. In the U.S., of course, DJ Trump will take office, pledging to reopen trade deals and reevaluate bedrock foreign policy principles such as the so-called One China policy. The the Italian Prime Minister there, Renzi, resigned after a vote rejected his constitutional changes. In France, Le Pen, the far-right leader's opinion polls going into this spring, leads opinion polls spring's presidential elections in Germany, where elections also loom. Anti-immigrant attorneys for German party have sought to capitalize on mounting opposition to the Chancellor there, Merkel. Open door policy for refugees fleeing the Mideast war zone, which some believe have left the country vulnerable to terrorist attacks such as the one in Berlin on the 19th of December. And almost a third of bond investors surveyed last month by Bank of America's Merrill Lynch identified populism as their biggest concern, up from 9% in October. Populism has been seen in the world before. It's not something that has just appeared. In the 30s, they had that particular move, and the Nazis took power there. Collectively, anti-establishment forces may represent the greatest threat to what Samuel Huntington, he's a historian, called the Davos man, a cross-border species whose values and interests are often divorced from those of his insular compadres. While each populist movement is unique, all share a general disdain for elites, however defined, and by extension the economic prescriptions they promote. Huntington, who died in 2008, may have had a divine future, which he said America might eventually rebel against rising immigration, especially from Mexico, and growing influence of multinationals and business concerns. Some at Davos regulars worry that the sentiments will lead the U.S. and other nations down a quote-unquote a dark path. There's no doubt about that, of economic stagnation, poverty, fear of the international. It was after the 29 crash that Nigel Woods, he was dean of the School of Government at Oxford University. We have to really learn the lessons of 1930. No doubt about that. This year's conference will make it clear. A degree of anxiety sessions include a panel of psychological experts, squeezed and angry, how to fix the middle class crises, and so forth and so on, from the International Monetary Fund, Madame Lagarde, with the hedge fund billionaire Ray Dalio, and the Facebook executive Sanderberg, Meg Whitman of Hewlett Packard, and the Chinese premier will be there. That will be his President Xi. He would be his first Davos. He's pitching a Chinese-led arrival to the Trans-Pacific Partnership. That was meant to cut China out of the business, so to speak, there. Critics predict the death of Davos consensus after the 2008 global financial crisis. Well, things have changed, no doubt about it, but this is where things are very interesting indeed. Some of the characters have ended up in the Trump cabinet, cabal, or whatever you want to call it. His National Economic Council Director, Gary Cohn, he has been around Davos forever, and at one time he was the president of Goldman Sachs. So in other words, what is happening here, especially in the U.S., that this populism of this DJ Trump is a thinly disguised populism. You have more and more influence by the Goldman Sachs proteges than you have had before, period. And a hedge fund person there, Scarmuzi has traditionally hosted one of the event's best attended annual parties. Now, you have these hedge fund managers, you have these people from investment banks, the former head of Exxon, one of the fast food kings out of California. You have all these people coming together, and they are not progressive but reactionary in their world outlooks. But at the same time, they do have a world view. This is something that we don't usually talk about on Numbers Man, because here we're dealing with macroeconomics, but it has to be understood in this vacuum of what actually is going. There has to be some sort of philosophical outlook to these various characters. One thing to remember, the Nazis were a pro-property philosophy. In other words, National Socialism protected private property, so nothing has changed there. What has happened is the de-emphasis on the internationalization of quote-unquote properties to a nationalistic type of property, but that in itself is something we'll see and continue to see. Let's move on here. Home sales. Very interesting. Tutzler is the site. Why they failed. Deals to sell homes are falling through at a faster rate than they were a year ago. Agreements for starter homes are the most at risk. National sales have fallen at an increased rate, rising to 4.3% in Q4 of 2016 from a 1.4% of all listed properties during Q4 of 2014. On an annual basis, failure rates have nearly doubled, 3.9% in 2016, up from 2.1% in 2015. New homes and very old homes are likely to see deals fail. As of Q4 2016, homes built in 2016 have amongst the lowest proportion of failed sales at 2.6, but the proportion increases steadily as the age of the home increases to 5.2% for those built from 1959 to 1969, and they fall to an average of 3.5% for homes built from 1900 to 1920. Of all listings, the largest 100 metros, that's in the U.S., 1.7% of starter homes fall in the most recent quarter compared to 6.7% of trade-up homes and 3.8% of premium homes. For all of 2016, the failure rate was 2.3% for both starters and trade-up homes and 3.6% for failure homes. Now, during the 2-year period, places with the most failed sales were predominantly in the West, with Las Vegas leading the pack at 7.6%. In Tucson, Arizona, saw the largest rate of failed deals at 13.9% of all unique listings. For 2016, Ventura County, California, had the highest fail rate of 11.6%, up from 3.1%. Since Q4 of 2014, the share of listings that fail at least once have increased to 2.9%. Among the possible reasons we suspect is the increased number of first-time home buyers are getting back on the dance floor now and listing where home sales were most likely to fail. Portland, Oregon, San Jose, California, Ventura County, Los Angeles, Orange counties, all out west. Fort Worth in Texas, Atlanta, Georgia, still problems there, Charlotte, North Carolina, and Akron, Ohio. Now, they give the percentages here in Atlanta, 10.4%, in Fort Worth, 10.4%, also in Los Angeles, 10.3%, in Charlotte, South Carolina, 10.3%, in San Jose, 9.7%. In Portland, 9.3%. This is from Tusler. We'll put this up. First-time buyers make up 35% of the sales in 2016, up from 32% in 2015. This is according to the National Association of Realtors. Those seeking FHA loans were down. There are restrictions on the type of homes and amenities there. One indication that first-time home buyers are at least partially the source of increased sales fails is the increasing dominance of starter and trade-up homes that are falling through. Starter homes sales fell from 2.4% in Q4 as 2014 to 7.1%. So this breaks down some of the cities. If we look at Charlotte, 16.5% on starter sales. As in South Carolina, 15.3%. In Fort Worth, Texas, 15%. In Dallas, Texas, and in 2015, the percentage in Dallas was only 6.7%. So you can see where the changes are here. An average of 3.4% is 6.3%. Older homes are more likely to be in a sales fall. And as Tusler, the statistics here are very good. Leads the nation in metro failed sales, and the methodology here. We'll put this up. And this is a very interesting scenario here, where housing sales are one of the bedrocks of middle class as far as financial stability is concerned. Let me go to the PMIs here, and we have several of those to look at. This is from the Market People, the global PMI, and we'll also look at the U.S. The U.S. service service sector. I'm sorry, the U.S. sector, and what else are we going to look at here? The U.S. and these are more recent ones. We were looking at some of these when they were released. We won't do the U.K. Nova Scotia. And the U.S. service. Well, no, we've already done that one. Sorry about that. These were released in more recently here, so we'll do these two. Let me just make sure that we don't leave anyone out. This is on the 9th of January. This is a global sector PMI and the U.S. Sector PMI. We'll do those two. I thought we had one more here to do. Oh, no, those are UK. Yeah. Okay. This is U.S. Sector PMI. This is released on the 9th of January. Financials remain the fastest growing sector, followed by consumer goods. All seven sectors post the highest quarterly average in Q4. That basically means the economy is in pretty good shape. It was in Q4. Now we're into Q1. Basic material production rises solid again to round off a strong finish to the year. The release of the U.S. sector PMI data from market points to strong economic upturn in December. All monitored sectors show growth here, and the strongest year, providing reason to be optimistic about 2017. Financials a top performer, despite easing slightly from November's 27-month record. Notably, new business and employment also rose sharply. However, financials was only the second fastest growing sector. The top sector, according to the year average, was consumer goods, mirroring the trend seen across all seven sectors. Along with the upturn in consumer goods, marked improvements in basic materials performance towards the end of 2016 helped U.S. manufacturing out of a slump in the early part of the year. That was in Q1, Q2. However, the growth in basic materials picked up a 20-month high in November, then remained solid in December. And growth in December then picked up we already talked about Q3 and Q4. Consumer services slipped to the foot of the league in December, but needlessly noted a pickup. Healthcare was the worst performing sector. Now, much of that revolves around the controversy involving the Affordable Care Act, which the Republicans in the American Congress, the House and the Senate, are moving to dismantle. And there will be a lot of controversy in that particular situation. The market global sector PMI, that was released also on the 9th. The outlook in the tech sector hit a 20-month high. Technology equipment led the detail sector there. This is the global PMI data showed technology ended the year as the fastest growing area of the global economy, followed by financials. Moreover, the tech sector registered the strongest rise in business activity ahead of financials and consumer goods. Consumer services and telecommunication services saw comparatively weak rates of expansion. Now, this is very interesting here when you start looking at telecommunication services. During the overall performance of technology sector, technology equipment, which posted the sharpest rise in output since 2010. In contrast, software and sales registered a markedly moderate increase in activity and ranked 17th in out of 23 detail services. Our strong performers in December included the automobile and automobile parts industry. Most people don't realize we have the automobile, but we also have our parts industry that surrounds it, and it in fact creates, if you look at Detroit in the U.S. As an example, that is a very, the parts and supply industry is a large one. Foods and banks, meanwhile, growth in was the strongest in 6 years. Food and banks, meanwhile, growth in metals and mining output erased from November's near 6-month record, but needlessly the second fastest in 3 years. Media was the only detail sector to record falling business activity at the end of 2016. Let me just up this a little bit here so we can and review. Looking at the PMI data, the average quarterly basis for the 8 sectors monitored 2016 was generally a trend of strengthening expansion across 5 of the 8 broad categories. Basic materials was the only broad sector to see a decline. Industrial growth remains mute. Financials registered a weak performance in the opening part. We already talked about that. And we start to look at this output business activity. Basic materials were at 56, consumer goods at 55, consumer services at 54, financials at 53, healthcare at 52, industrials at 51, technology at 50, and telecommunications with 49 was the bottom. And looking at pricing, basic materials at 66 there. So let me just, okay. Technology led the growth in Q1, Q2, but slipped to 5th in Q3 and rebounded in Q4. Consumer goods and consumer services, differing trends there. Consumer goods production growth slowed in Q2, and while consumer services expansion picked up by the second half of the year. a different story as goods output growth rebounds strong in Q3 and Q4. That used to be the normal patterns that we had because of holiday shopping, etc. Q3 would set up Q4, and that's what happened this year. Now, Q1 of 2017 will be very interesting. Usually, if you come off a strong Q4 the previous year, Q1 will usually be a pretty good year. Basic material was the only area to see a falling input price there. And looking at some of these where technology is, this is output business activity and input pricing. Healthcare services were no doubt hurting there. So this is where we are in the PMIs. Decent year, no doubt about it. Let's go to the BBC. No single factor behind the sterling and its crash. That's according to the Bank for International Settlement. We talked about this after Brexit in the early hours of the 7th of October. The pound fell 9% against the dollar. A normally large swing in the two widely traded currencies. The Bank of International Settlement said there is no significant loss. There were no by traders, but said the lesson should be learned. It drew on an analysis from the Bank of England, which said the conditions for such a move was created by the lack of sterling dealers in the market at the time of day. Vulnerability. The Bank of International Settlement does not point to actual events or pieces of news for causing crash reports. So some of the things going on here: significant demand to sell sterling to hedge fund option position and the execution of stop loss, or what is some of the machinations that you see behind the markets there. Such events have the potential to undermine confidence in financial markets, the impact of real economy. And that does happen. This is where you see the macro part entering in. Usually we think of governments, but also we can have situations where, as with sterling, the fall there caused by international traders. Now, back to this banking boom going on here with several of the actors since the election of the Trump regime, or at least the setting up there of these various banks set off a wave of activity. J.P. Morgan rose 0.5 on Friday, while Bank America shares also reported a rise in profits of 0.4%. U.S. shares have soared in recent weeks with hopes that the bank regulations will loosen. Now, the loosening of bank regulations, make no mistake about it, will be good for banking stocks, but not for banks. J.P. Morgan, the biggest bank by assets, reported a 24% growth in profit to $6.73 billion. That's 5.5 billion pounds in the final quarter of the year. We grew market share in virtually all of our businesses and show expense discipline while continuing to invest for the future. That is from J.P. Morgan's Demond. Demond here, who had been, well, he's not, potential nominee for Treasury Secretary. On the Bristol U.S. Bank results, Bank of America posted a 43% rise in net income to $4.7 billion. Wells Fargo, its fifth straight decline in quarterly profits. It was under the scrutiny of regulators for basically lying to the public. The Federal Reserve raised its benchmark rate 0.5% to 0.7%. That was in December. And the rate usually helps banks because it allows them to charge more for mortgages. And this is one reason, beside Ralph Nader's pensioners letter, that banks have opposed the Fed's low interest rate. In other words, we expect now, depending on the economy, at least 3 different rate increases in 2017. Now, perhaps 4, because again, you have a strange mixture of things going on. A lot of quote-unquote promised jobs. The immigration situation will change, but at the same time, you could have a trade war. And out in rural America, there's that predominantly agricultural. They fear a trade war type situation where commodities will be hurt because the tariff wars will go on. And at the same time, you have a fall in exports in China. We'll be covering that from the World Economic Forum and see where that will lead us. In other words, there's still a severe demand problem out there. That is the reason DJ Trump is moving for stimulus. That was one of the things that the Bank of Japan did, stimulus to get Japan out of a deflationary period they were in for 10 years. Now, we have observed petrol, gasoline prices going up in the U.S. Roughly, if the tank, as they call it, you've had an increase there of over 50%, about 60% the last time we looked flying by on the metro. Wells Fargo, which is dealing with the scandal, there fell 5%. Its profits were at $5.3 billion in the quarter. And they've had a change in management there. Let me go to the market data and see if we can sum up what is going on here and look at the markets. We'll see when they are. The BBC Global 30, this is on a Friday, was at 40.98. The FTSE on Friday also, we'll do the all shares at 22.70. In Amsterdam, they were at 5. In Frankfurt, the DAC was at 108.14. In France, the CAC on Friday at 58.52. In Brussels, they were at 45.59. And in Madrid, 104.20. In Zurich, also on Friday, 77.17. And in Moscow, they were in red at negative 16.81. Also in Johannesburg, the all shares were at negative 294.82. And in Bombay on Friday, they were at negative 9.10. In Karachi on Friday, negative 329.07. And in Lahore, also on Friday, negative 45.11. In Colombo, their all shares on Friday were at 33.18. And on Wednesday in Tehran, 7,000, wait a minute. Holy moly. 78,662. To read the number there twice. And nonetheless, in Sydney, also on Friday, they were at a negative 45.80. In Nikkei on Friday at 152.58. The Hang Seng at 108.36. And in Shanghai, they were at negative 6.52. And the Dow on Friday at negative 5.27. Whereas the tech-laden NASDAQ was at 26.63. The commodities market out in the Midwest city of Chicago at 4.20 on Friday. In San Pablo on Monday, They were, let's see, at a negative 1,046.71, and on Friday in Mexico, they were also in the negative at 648.42. And we got everyone here. Okay, on to the commodities. And we'll see where petrol is today, or the last reporting day that we have here. Brent crude was down 44 cents at $55.57. The spot was down 45 cents at $55.56, about the same price, a penny there. And West Texas crude was down 50 cents at $52.51. So they're hovering around the 52 to 55. There, no movement since last week. Coffee futures, let's see, we're down 30 cents. Gold was down $10.30 on the Forex at $1,196.30. Dubai gold futures, and we're up $1.40 at $1,098.80. Silver was down 15 cents at $16.76. On to the Unix Life Futures. We usually give this one. Cocoa was down $14. Robusta coffee was up $4. And white sugar futures were down $4.70. The Bloomberg Commodity Index at 88.54. And it was up 0.6% there. And that was on a Friday for Bloomberg and their commodities index. So we come at basically two different ways here. We've come in on the BBC Global 30 and the Bloomberg Commodity Index 2 that we are using. I don't have the Russell index here. I'm just looking at economies here. The German economy accelerated. We'll go ahead and give this one. We usually accelerate in 2016. Now, how this will affect the government there, we don't know. This is from the Federal Statistics Office. Said gross domestic product was 1.9% higher last year than in 2015. Excuse me. The annual figures based upon an early estimate that growth was around 0.5 in Q4. This actually will not be released until next month. The 1.9 figure for 2016 was slightly above expectation, built on growth rate of 1.6% in 2014, 1.7% in 2015. So a little bit better, almost 2%. Exports were up 2.4%, but was outstripped by import growth of 3.4%. Household spending grew at 2% in Germany. Government spending was up 4.2% there. The country has enjoyed several years of economic growth, usually unusual for a developed country, and it has a budget surplus. Last year's total of 0.6% of gross national product, down a touch from 0.7, but still in good shape in Germany. The economy's in good shape. We'll see how the populist campaigns pan out in Germany. Is the economy pushing this, or do we just have a nationalistic campaign against immigrants? I fear that is a fear. Is more of what is actually going on there. Let me grab this in here. Basics risks now lower, according to them. We did have something on May, but we'll have to get to May later about some of the drops that she's coming. This is from I believe from the Bank of England. This is Mr. Carney, said that action by the bank before and after the vote to leave the EU. This is an example of what central banks can do. He added, however, that the overall level of risk was still elevated, no doubt about that. And in fact, that process of disengagement will start in, I believe, in April. The risk is greater for continental Europe than the UK, he said. The governor also told members of the select committee that a period of transition was highly advisable. Now, he also expressed the belief that it would not only be possible, but desirable for the UK to remain as part, and this is of the EU mechanism of it makes financial rules. Maybe it will, maybe it will not be part. The Bank of England's chief economist there, Andrew Halding, admitted that some of the criticism of economic forecasts about the immediate were justified, but he told the committee economic forecasts have improved since the crisis. That usually happens. There's usually a market, pessimistic view many times when you are changing over, and this was a very big a transition happening. Mr. Carney agreed with the chair of HSBC that the financial structure of the city that's to the Treasury Select Committee there. So we'll see. The city is the London part of the financial sector, and we'll see how that is going. This will do it for us. For those in business, make next week a productive one. As in the U.S., we will be busy with our transitioning from one administration to the next administration. And also we'll be looking at the economic data that will come in early September. We'll have a special report, incidentally, on Davos. The World Economic Forum will be coming up. We'll have either one or two reports across our channels. The political part, we'll have that over on what's called Bostonred, and we'll talk about the economy here. And we also have our international program, BR on the World. We'll be also talking about that because we are talking about global economics. So we'll have a lot of things going on next week globally here from WBRN Radio in Boston and over the Bostonred Network. This has been Numbers Man on the 15th of January 2017. And we'll talk to you with this program next week, but we will have some special programming in the interim on most of our outlets here on iHeart and on the other outlets, Speaker, Blog Talk, and our European outlets. We are developing more and more there, and we're appreciative of people around the world that are listening to our programs. And of course on YouTube, we're starting to very, very slowly develop an audience there, and we'll be in with the video part because we need that for our charts. We don't have it this morning. We just have audio.